Hello, in this video we'll consider general investment deductions. Now recall that there's three categories of deductions. The three categories are business, investment, and personal activities. Now with respect to these three categories, which I sometimes refer to as the big three, generally speaking, taxpayers prefer to have business, then investment, then personal. The reason that business is the most sought after is because there's the least limitation on it. Investment is next most sought after, and then personal is last. The reason, business and investment also together in the case law and the code have been referred to as gain-seeking or profit-seeking activities. Personal, though, is not. It's separate. The general rule is that business and investment deductions, they are, generally speaking, deductible if certain criteria are met. But for personal deductions, the general rule is that personal deductions are not allowed unless the Internal Revenue Code specifies otherwise. So we're talking about investment activity, and there's previous discussion about the general business deduction, which again is the first one you should consider. So if you don't meet the criteria of the general business, next you should consider investment, this checklist. So the general investment deduction is under section 212. And through the Higgins case, Higgins versus Commissioner of Internal Revenue, which is a very important case for the investment area, the same 7 criteria, except for one item, the same 7 criteria as section 162 must be met except for number 6. So same 1 through 5 and 7 as section 162. And I'm going to go ahead and read those off, but I recommend going back to that discussion with respect to those criteria, because if you fail any of those, you can't get section 212 either with respect to this provision. So I'm going to go through numbers 1 through 5 and 7. So number 1, ordinary. Number 2, necessary. Number 3, must be expenses and not capital expenditures. Number 4, paid or incurred during the taxable year. Number 5, in carrying on. Number 7 is that there must be adequate substantiation. Now number 6 of section 162 is that it must be trade or business. For this investment purposes, it does not have to be trade or business, but it must be investment. And that brings up the Higgins discussion. So the Higgins versus Commissioner case is where the distinction between business and investment, this is the main case because it was a U.S. Supreme Court case. Business versus investment activity. And this was discussed in section 162 as well as all of these criteria, the distinction. But I just want to highlight again that when you're looking at business versus investment, you really have to focus not on the profit mode because, again, business and investment both are profit-seeking. What you focus on is a sweat of the brow notion. You actually are doing actual items with respect to the activity. So if there is a lawn mowing business and you are an owner or you have an outflow, if you're actually mowing the lawns, yes, that's considered business. But if you are just an owner and you just invest capital, so capital seeking, then that's not necessarily the same. That's not sweat of the brow. Also, under the Commissioner versus Grotzinger case, it must be continuous and regular. Now, once you have that distinction down, I want to talk about 3 categories of what generally are thought of as, and they're listed in section 212, of the activities that are considered investment, generally speaking. And these are very broad, open, it seems pretty open-ended, but again, it goes to that. So the first is production or collection of income. So the first one's production or collection of income. Is the expense paid or incurred in the production or collection of income? So what we're talking about here is and this seems very general because you're like production or collection of income. This can be pretty much anything with respect to owning stock, bonds, owning investments. So maybe you have a loan that you pay interest on, and with that loan you purchase various stocks and bonds, and you collect capital gains off the sale, or you collect interest on the bonds as as the maturity or as the time is going, and the issue becomes the interest, the outflow, the interest you're paying on that loan to secure those. Is that going to be deductible or not? Well, again, we look at the activity. As long as it meets the numbers 1 through 5 and number 7 of section 162, then that's good. But to be investment, with respect to production or collection of income, owning investments is a perfect example. The next one, so I gave the example of interest expense on a loan to secure. That's an example of that. Interest expense. And there's a specific code section laid out for interest, just so you know, but I'm just giving you a general idea of what we're talking about. And you can think of various other types. There might be other expenses with respect to that, to the investments. Maybe you're paying a broker fee. That's another example. And this isn't just limited to owning investments. Again, it's in the production or collection of income. So next is the maintenance of property held for production or collection of income. So is the expense paid or incurred in managing, conserving, or maintaining property for the production of income? So this one is dealing more with, renting property, renting land, buildings, whatnot. And if you're paying various outflows with respect to the item, you're paying, you're paying a lawn mowing company to come in. You're paying maintenance on the property, repairs. Those kind of things, right? Mow the lawn, so lawn mowing. Maybe there's a pool cleaning on the property. Maybe you pay an actual management company to manage the property for you, like a realtor or something, a management fee. And this is perfect because you actually see that with respect to investment, there's no sweat of the brow. So you're actually paying all these costs and you're getting that money from your invested capital. This is perfect to understand. So the last one is tax matters. Tax matters. Is the expense paid or incurred in the connection with determination, collection, or refund of any tax? This is interesting because this even applies with tax preparation. Tax preparation or tax planning. So if you pay for a CPA to do your taxes, or plan your taxes, tax issues, it qualifies as an investment activity right here. It's specified in section 212. This one is a little easier. It's more narrow than number 1, number 2. Number 1, number 2 are a little bit more broad, but the idea is that, again, there must be an actual profit and it can't be business. Now, how do you distinguish between personal? Well, one way to distinguish between personal, whether your investment, is you actually have to hold yourself out with respect to profit seeking. Again, the key is that profit seeking idea. And there's been cases out there for people trying to sell their houses, whether they actually invested or not. And there was actually a case that said that because a renter, they listed their property just for a few days and then they sold the property later on, even though they lived in it personally before. They actually held an investment. So there's been some crazy cases out there with respect to taking personal property, converting it to investment seeking. And we're going to talk later in later topics about what happens when you convert property from personal to investment or the opposite and how that affects various issues. But this is just a general discussion of what exactly is investment. So again, the key is you have to meet all the same criteria 1 through 5 and 7. So the last thing I want to discuss is we talked about how business deductions generally are above the line. Well, investment activities are generally, so that's business. Business are generally speaking above the line. With respect to investment, most investment activities are below the line deductions with respect to the taxpayer. So remember, we talked in the general deduction discussion that it's better to have above the line because, number one, you don't have to worry about the standard deduction issue, right? Because you get to take it. And number two is that below the line deductions are more limited because they're subject to AGI limitations and phase outs and whatnot. And it's just a percentage. Well, that generally is the case. So investment activity generally is considered a below the line deduction. So make sure you keep that in mind. Now, it's possible you have an investment activity that is above the line, but generally speaking, it's below the line. So that really concludes our discussion of general investment deductions.